Gautam Trivedi, Managing Partner at Nepean Capital, is joining us right now on the show. Gautam, thanks very much for taking out the time. Let's talk about the market mood right now. And
Sure.
much anticipated.
Pleasure to be here.
Much anticipated, rebound, pullback rather, after the record highs that we've recently seen. Should one get too perturbed?
I think the liquidity that you've seen that's come in, especially in the last 6 months, it's the sole reason the market's actually been going up. So the current performance of the market is completely devoid of the ground fundamentals, as we all know. And I think the most startling and striking evidence of that is the fact that the RBI's own semi-annual monetary policy report, which basically has, I think, some scary numbers. So, for example, they've said that the first half of FY19, we saw a total credit in the system, total money supply into the commercial sector, which includes everything, literally, banking, bank funding, NBFCs, ECBs, QIPs, IPOs. So all of that put together was about 7,34,000 crores. That's, again, for FY19, the first 6 months. For the first 6 months of this year, i.e. FY20, that number is down a whopping 88% to 91,000 crores. So that clearly tells you that we have an economic situation which needs to be corrected. And the market, of course, seems to be completely ignoring a lot of these numbers, even if you say the market is future looking. But still, I think it defies gravity the way the market's been behaving.
Yes, it does. Gautam, good morning. So the question is, fundamentally, is the market looking 6 months out, and are you looking that far out and trying to allocate money? The finance minister or the government is on a bit of a market appeasing spree of sorts, and if indeed this personal tax cut comes in, that could give one more leg too.
You know, I think the personal tax increase in the first place itself was unnecessary, and in fact, I think has had a major negative impact, because on one hand, you're looking at the government looking forward to private sector capex, but the very same people, and I assume a lot of those are going to be in the 5 crores plus net taxable income bracket, if you're going to tax them at a rate which is, as high as 42.7%, frankly, what is the incentive for a entrepreneur who's in that league to actually put in more capex? So I think that has to be reduced as soon as possible, frankly. And I think lower taxes will actually help spur the economy at a broader level, and I don't mean simply at the investment level, also at the consumption level. So yes, the government should do that. That's long overdue. Question is, when are they going to do that? There was a lot of chatter it would happen around or before Diwali, but it hasn't happened for whatever reason.
Do you then believe that this consumption slowdown that we're talking about, if there is more money in the hands of the consumer, at least for essential items and FMCG goods, this could be, something that could see a significant upturn in terms of their numbers and volumes?
Yes, but let's hold back on that, because I think most of the FMCG companies are seeing a slowdown in the rural area, in spite of the fact that we had a pretty decent monsoon. So I think you will see more pressure on their margins. Of course, a lot of the high valuations have come off in the last month or so. But the fact is, I think that sector is still struggling, even though globally these are among the most expensive valuations for the FMCG companies.
It is. Okay. Gautam, want to talk about a few pockets. I mean, automobiles, themes that you like, companies that you like as well. Let's start off with automobiles, because they are in focus. Now, we don't know how much would this tax cut spur automobiles, but Maruti, we were talking to the management the other day, and they sounded very optimistic about more profitable growth over the next 12 than the previous 12. We've seen that production numbers moving up for the month gone by as well after a 9-month cut. How do you think the setup is for two-wheelers, for the space at large? How does it all move?
Yeah, that's a good question, because I think what we saw between the year 2001 and 2013, we saw, for example, in the passenger car segment, we saw a compounded annual growth rate in terms of volume sales of 13%, 1-3. However, from 2004 to 2019, i.e. over the last 5.5 years or so, we've seen that compounded annual growth come down to only a mere 6%. So there clearly is an issue and a problem. I think, on the tax front and the GST front, I don't think a lot of people actually know this, but there are actually 6 slabs within the auto space. And also the constant back and forth within different ministries commenting on what should be done with respect to GST for the automobile sector has left consumers confused as to what really to do. So I think there are issues which are obviously very significant. The CV space has been particularly hurt. Ashok Leyland just announced some more production cuts for the month of December. Though I think intrinsically it's a great story, but and everything's good at a price. But the fact is, if you're still in the month of December and in the current month going in for production cuts, it clearly tells you all is not well on the CV front. Specifically on passenger cars, the month of October was the best month specifically year to date, because you had the twin festivals of Dussehra and Diwali together. And usually and historically the month after Diwali has been a weak month, but November surprisingly wasn't as bad. So I think there are some green shoots. You've also seen cars like the MG Hector, which obviously has done extremely well. So there are certain pockets which seem to be doing better. The bigger issue with the automobile sector, besides just GST and the confusion around it, is the fact that the lack or the limited availability of financing. So even when I speak to NBFCs or banks who have been very active in the automobile financing space, have said that they're significantly retrenched. So the number of rejects for automobile loan applications has now, I believe, hit as high as 25%, which wasn't the case a few years earlier. So I think financing is, again, a very important element of the automobile financing, automobile sales. And as a result, if that doesn't improve, I don't think you'll see that improve anytime soon.
Right. Gautam, while your point is well taken on the rest of the pack, we had Muthoot Capital joining us just a few days ago talking about two-wheeler financing. And he said that they're actually doing okay with regards to growth. And for the two-wheeler space, the dynamics are pretty different from what passenger vehicles or CVs or the others are. It's more of a necessity at times for people to travel from point A to point B. So not more of a luxury, but more of a necessity. In that sense, do you feel that two-wheelers as a pocket will likely do much better?
It should do better because it's a lower ticket item. So I would think that should clearly do better. And as you said, if indeed the financing is a lot better and NBFCs like Muthoot are willing to indeed fund the two-wheeler space versus the passenger car or the CV space, then I guess that should be positive news for the two-wheeler industry.
Gautam, just wondering, with regards to automobiles, or maybe we can segue into others as well, I would guess that buying into a space right now should be a factor of whether earnings growth and what is the print on earnings can be predicted for the next 2 or 3 years. Do you get that comfort in auto right now, the predictability of what the earnings could be? And if not, where are the pockets or where are the themes where you believe there seems to be certain predictable growth?
Yeah, I think I think I must add one more interesting data point, which I learned from one of the auto dealers. And they said that the used cars as a multiple of new car sales used to be around 3 years ago, it used to be about 0.8. Now it's 1.3. So, clearly customers are more interested in buying used cars versus buying new cars. But, having said all of this, my personal view is that we're still about 12 months away from seeing a significant revival in the auto sector. So we've actually stayed away from we're obviously a mid and small cap fund, so we don't invest in the large caps, but we've stayed away from the auto anch companies for a very specific reason. And also the ones that are export oriented, even those, of course, there's a global auto slowdown as well, so it's not limited only to India. Though I personally believe that a lot of the problems that we're seeing in the automobile sector in India are very local and created in India versus being impacted by the global auto slowdown.
Gautam, where is it that you currently seek value in terms of even individual stocks and not just sectors?
Yeah, that's a good question. I think what the market is fed up of, and again, this is evident right across where you've seen large caps become mid caps and certain large caps that have become small caps or even micro caps. I think that the market is fed up with poor corporate governance, high debt, and where you've seen so much negative press around companies blowing up, banks blowing up, certain promoters fleeing the country and not traceable. So I think in the midst of this, the market has gravitated, and I can even use the word polarized, towards good corporate governance or good companies with good ownerships. So let's take, for example, you've seen Spandana Spurti, okay? Good company otherwise, but now that you've got Kedara owning as much as 49%, Kedara Capital is one of India's largest homegrown private equity funds. And that stock has done phenomenally well. Similarly, one of the stocks that we own is Aavas Financiers. And in the case of Aavas, Kedara and Partners Group collectively own 58%. So as a result of that, what we've noticed is that the flight to quality, and Aavas has been a huge beneficiary of that, when you know that the owners are private equity funds, and hence as a result, the perception is, which I'm sure it really is that the level of corporate governance, the leakages, if they were happening in the past, I don't mean specifically on Aavas, but I mean in general about companies, those will be either eliminated or significantly reduced. So as a result, I think people are gravitating towards companies that are well run, and hence you've seen the huge run up in valuations for a lot of the blue chip names in India.
Okay, that's an interesting way of approach. Now, so we might see this, Gautam, in pockets which are maybe slightly small or maybe bordering on fintech or technology based. I mean, PE interest. I don't know if you think otherwise, but just wondering. So when one fans out the larger market landscape, would you be largely looking at such companies, or are there some earnings backed steady performers that you're willing to put fresh money to work right now?
If I can answer that, but I forgot to mention a couple of other stocks which have seen that sort of significant change. So let's say, for example, SL Propack. Blackstone now owns 75% of the company. I think SL was a well-run company anyway, but the fact is a lot of investors in the past few months have now started to look at SL and see what Blackstone, which is probably now the world's biggest private equity fund, is going to do with SL. So that's one example. The second being Z, where the underlying business, of course, has been impacted by the economic slowdown, but nonetheless, you've seen the fact that the company got a major D-rating when the promoter pledge issue came out. Now with the promoters down to less than 5%, and Oppenheimer being the single largest shareholder, a lot of confidence is coming back into the stock. More importantly, there will be a strategic partner that will come in at some point, as I read in the press, to take a significant stake as well. So given all of that, again, that's another stock that has either hit a bottom, or the market is now starting to wake up to where this could be 3 to 5 years from now, given that the promoter pledge issues are mostly out of the way. The other stock that we actually ended up acquiring, which in our portfolio, is Nepean India AMC, which of course ran up a lot also on the back of HDFC AMC's valuations, but more importantly, with the change in promoter and Nepean now owning 75%. So again, these are examples of where, not limited, as you said, to only financials, but like SL being a good case in point, where we've seen that re-rating starting to come in with the change in ownership.
Interesting. Just a follow-up there, Gautam. If you are at liberty and willing to talk about it, SL Propack, and you were rightly saying, I mean, it was classified as a Subhash Chandra Group stock. It wasn't. It was a very, different entity owned by the brother, which is no connection, well-run entity, now a Blackstone company. Is the theory that Blackstone having these multiple global partners and SL being the world leader in packaging would actually now find more foot in the door into a lot of other global peers? It's a proven performer, and therefore, never mind the valuations, the growth in business at a global level would now accelerate?
I think that's a logical conclusion, and I would assume that's the very reason that Blackstone made that investment and bought as much as 75%. So I suspect, we haven't done that much work on the company as yet, but I suspect that is exactly what a Blackstone would or should do, given their global reach and the fact that they are present in so many countries, including other emerging markets.
Okay, Gautam, one follow-up and one final question from my end, and that's on the Indian retail space. And the reason I bring it up is because of a technical conversation around how Radhakishan Damani, in order to reduce stake, because to meet the mandatory requirement, might come out and sell some stake. The company might start off as well, some fundraising. My question is, should market participants or would portfolio managers like you look at these valuations in isolation that they are high, or would it be prudent to look at the entire space and see that it's not just DMart which is at abnormally high valuations? Companies like Trent are not cheap either. Some of the other well-proven retailers across the world have never traded cheap. So maybe these companies by nature would continue to trade at higher valuations.
I think you raise a very, very important question, and I keep getting asked this question regularly, especially by foreign investors, as to why is HDFC Bank at 5x or 4.5x FY21 price to book, or for that matter, one of our investing companies, Aavas, is at 7 times price to book. So I think this is not isolated only specifically to one or two companies, but it's across the board where you see valuations in India significantly higher, not just versus their Western peers, as in the US or European peers, but also with respect to other emerging markets. And my answer to that really is the fact that Indian investors who are domestic Indian citizens do not invest overseas, even though they can remit under the LRS scheme up to $250,000 per family member, and essentially they can invest in global markets. That hasn't still taken off. So given that situation, I think Indian investors continue to bid up good quality names, and those valuations will indeed remain high for the longest time. Will they correct and then again go back up again? That's very much possible. Again, I'm generalizing, but a stock having a high valuation is not a reason not to invest in it, at least from our fund's perspective.